This problem says on December 31st, 2019, Roby Company accumulated the following information for 2019 in regard to its defined benefit pension plan. We have service cost, interest cost, expected return on plan assets, amortization of prior service cost. Then it says on its December 31st, 2018 balance sheet, Roby had reported an accrued prepaid pension cost liability of $14,100. Compute the amount of Roby's pension expense for 2019. And then we have a few more requirements, but we'll just start there. I went ahead and copied our little calculation for pension expense that we did in a previous problem so that we can just quickly pull that information. And so service cost was $113,390. Interest cost is $11,810. The expected return on plan assets, we want to subtract that, so we'll put the negative in front of it, $11,250. Amortization of the prior service cost is $2,130. There's not a gain or loss in this particular problem. And then we can do the sum for $116,080. And so that's our answer to the pension expense for 2019. 2A, assume Roby Company funds the pension plan in the amount of $116,080. Prepare the entries to record the pension expense for 2019 on December 31st and the amortized prior service cost for 2019 on December 31st. So we'll have December 31, and in this case, the pension plan was funded in this exact same amount as the expense, and so we'll have pension expense, oh my heavens, pension expense and cash for the $116,080. I'm going to just format this really quickly. Then also on the 31st, we need to deal with the amortization of the prior service cost. And so that's going to be a debit to accrued / prepaid pension cost and a credit to the other comprehensive income. And I guess we should add to that prior service cost. And so that's going to be this $2,130. Part B says that we're assuming the company funds the pension plan in the amount of $115,170. Prepare the entries to record the pension expense for 2019 and the amortization of the prior service cost. And so in this case, it was funded for $115, but the expense was still $116, which means we're going to make up the difference with the accrued prepaid pension cost account. And so we can still pull this, actually, we can pull all three of these down. But we want this accrued to be a credit as well. And so the pension expense remains the same. It's still $116,080. It was funded with $115,170, and so the difference is being made up with the accrued prepaid pension cost. And then also on the 31st, we need to do our amortization, and that's going to stay the same. So we'll just copy that right down. I should have made these absolute. Woo. Sorry about that. Making up shortcuts I didn't even know existed. Okay, now assume Robbie Company funded the pension plan in the amount of $119,920 and prepare those same entries. So this time it's been funded for greater than the expense. So we're going to still have this accrued prepaid pension cost, but it's going to be a debit this time instead of a credit. So December 31st, we still have our pension expense for $116,080. Then we're going to have our accrued prepaid pension cost, and we're going to have cash, and cash is $119,920, and so the difference gives us the debit of $3,840 to the accrued prepaid pension. And then again, this amortization of the prior service cost remains the same. 3. Assuming Robbie's beginning 2019 accumulated other comprehensive income prior service cost balance was $55,640, what would its ending balance be? And so we'll just put here beginning balance $55,640. Then this year we credited that account for $2,130. And so we subtract that out and we get a balance of $53,510. Part 4. How much would Robbie need to fund its pension plan for 2019 in order to report an accrued prepaid pension cost asset of $4,870 at the end of 2019? So I'm just going to create a quick prepaid pension cost liability account. And so if we come back up, it had, balance sheet, it was reported as a liability of $14,100. So I'll pull that down. Then this year there was the expense of $116,080, and we want the balance to be an asset balance of $4,870, and so if we set up the T account, we can then solve for the missing amount, and so this would need to equal the sum of all three of these things to get us the amount that we would have to fund the account at for this year in order to get an ending asset balance of $4,870. And so that is the $135,050.